We have to strategize. I think it's tougher to trade a small account than a large account. Because we do have to think about how now, I like the entry signal, but how do I act on it without taking too big a risk? And in futures, for most people who don't have terribly large accounts, that means using options or perhaps spreading, but I prefer options. The key to money management, limit your risk. Many pros limit the risk per trade to about 1 or 2% of the account balance. Funds can do that with outright futures. Smaller traders should consider using options strategies to manage the risk. You have to start by deciding how much you'll risk. Consider your expectations for the trade. Be sure you know where you are wrong. And I already mentioned that I act on the close. For me, that's usually a close above or below a certain key hurdle. That would either be one of those big reversals that we were looking at, or perhaps a swing high or swing low that I was acting on. Factor in how long you expect to be in the trade and decide what strategy you will employ. I usually employ option strategies. Long-term options allow you to limit your risk and buy time. I'm reinforcing buy time. If you're buying options, buy time. The biggest problem with options is time decay. The more time you buy, the less time decay affects you. Here's a list of at-the-money euro-dollar puts that can help us see the effect of time decay. I thought this was very interesting. I'm going to just look at these two. We have a series of euro-dollar puts that were at the money at the time that I put this slide together. We must have had about 30 days to expiration for October 08 when I put this together. The cost of the put was 22.5 points, 22.5 euro-dollar points. Euro-dollars trade for $25 a point, so the total cost in dollars was $562.50, or it worked out to $16.54 a day to hold that option. Now, if we go out all the way to June 10, you're paying significantly more in dollars, but it only costs $2.65 to hold the option. And let's go to these two in particular. Here's the December. That had about 3 months to expiration at the time that I put the slide together. Cost 34 points. This one had, let's see, about 21 months to expiration, 7 times as much time. It only cost twice as much in points and dollars. I would definitely buy the long-term option. And once we'll go on to see that if you decided to exit at a certain point, the risk in dollars doesn't become much greater and sometimes is smaller than when you buy the longer-term option. And you also have much more flexibility. You can reconsider your strategy. Yes, sir?
Could you be more specific about the time options that you usually use? In other words, are you going out a year?
Well, yes, I do some stock work, and I almost always buy leaps.
Leaps, okay.
Yes. I'm looking at...
On options.
On stocks and on futures. In euro dollars right now, I'm March 010, or March 10, I should say. I do some stocks, and it's usually with options. And well, especially considering the time, I dabbled on the long side, but I'm going out over a year to 2 years. Oh, actually, a year to 2 years plus. So I think there's some value there, and we might see a bounce in the next couple of years. Buying more time gives you strategic flexibility if the market goes your way. I have found that with short-term options, if you do get the move your way when you want it, sometimes you feel like you have to grab the money, because who knows what the market's going to do after that. I'm not sure if it's the same with stocks, but with futures, the swings can be pretty quick and pretty risky. Once you get a swing your way, you're often inclined to want to take the money off the table. If you buy more time, you can use another strategy. Perhaps you just sell something against it, maybe that will already give you a profit, and be able to continue to hold the trade that way. Let's see, where were we? It leaves you with some premium value if the market goes against you and you decide to exit. Equivalent long-term options should make about the same dollar profit for an equivalent move in the futures. And if you're buying an at-the-money option at any time frame, in terms of dollars, you're going to wind up with about the same profit. Your percentages will be different. You won't be able to brag that you made 1,000% on something, but you'll probably make the same in dollars. And you don't have to hold on to it, but you can. Where if you don't buy time, it just expires. You don't have the choice. I'm repeating myself here, but if you buy time, you have to exit. You can get some money back. If you bought the euro-dollar puts that I mentioned, that I had on the earlier slide, and you only bought 3 months, if you want to get out, you don't have a choice. It expired worthless. You don't get anything back. Yes, sir?
How far into the money do you go?
I'm usually at the money. You'll see that my signals, I consider them somewhat precise. I act on specific, very specific swing lows or swing highs. And I feel that we're either getting a significant move in my direction or we're not. So at the money's fine with me.